I'm Dr. Jeff Jones, and this video includes the second half of the solutions to the comprehensive practice set in the Accounting Review booklet. So let's pick up where we left off. The last thing we did, part 1 of exercise 3, ended with the completion of the adjusted trial balance. And so I'll repeat that adjusted trial balance on the next slide. The next step is to make what's called the closing entries. And the closing entries are basically the entries that occur to zero out all of the temporary accounts on the adjusted trial balance. So if we look at our adjusted trial balance, we see again, keep in mind that it's organized in terms of assets, then liabilities, equity, revenue, and then expense. Okay? And also that debits must always equal credits on the adjusted trial balance. So let's look at exercise 3.6, which is closing entries, and there's 3 slides that we'll go through here related to closing entries. The first, part A, asks us to close all revenue and expenses to the income summary account. And so it also asks us to create an income summary T account. So what we're basically doing when we close the revenue and expenses is if, for example, revenues have a normal credit balance, we would need to debit our sales revenue account by the amount of its balance to zero it out. Okay, so it has a normal credit balance, so to close it, we are going to debit it. And the credit side of that entry is going to be to an account that we call income summary for $230,000. Regarding expenses, to close our expense accounts, which have a normal debit balance, we would need to credit all of the expense accounts. And so the offsetting entry then to close the expense accounts is going to be a debit to income summary. Okay, so if we sum up all of these expenses, they will sum up to $209,500. And so then when we look at the income summary T account, we can see that if we put those entries in there, we would end up with a balance in the income summary account, a credit balance of $20,500. That is essentially what your net income is. Okay, so this number should tie, once we get to preparing the income statement, that should tie back to that. Okay. Next step in the closing process would be to close the income summary account to retained earnings. And so to do that, recall that our income summary account had a credit balance of $20,500. So to close that account, we would need to debit income summary for $20,500, and the corresponding credit for that entry would be a credit to retained earnings for $20,500. Okay, so basically that's how we closed or added net income to retained earnings. Now, part C, the final step in the closing process, would be to close the dividend account to retained earnings. And recall that the dividend account is a temporary equity account, okay? And so basically it reflects the dividends that were paid over the period. So dividends, since they are a contra equity account, have a normal debit balance. So we would need to credit dividends of $10,000 and debit retained earnings of $10,000. So this is actually reducing retained earnings. And so that makes sense because dividends are paid out of retained earnings. So dividends reduce retained earnings. And again, that $10,000 amount comes from the 50-cent dividend times 20,000 shares outstanding. Okay, finally, exercise 3.7 now asks us to look at what is ending retained earnings. And so ending retained earnings, in this case, if we had a beginning balance of 0, since this was a new company, we had an addition of $20,500 related to basically the net income added to retained earnings. And then we had a reduction in retained earnings of $10,000, which is basically reflects the dividends paid. And so our ending retained earnings balance will be $10,500. And this should tie to our balance sheet and also tie to our statement of changes in shareholders' equity. So next up, let's look at the income statement. And we've already kind of given you the structure of the income statement in the exercise booklet. Basically what needs to be done is you need to plug all the numbers in. And so what we're basically going to do is bring all of the revenue and expense numbers that were reported on the adjusted trial balance over to the income statement. So we would report our sales revenue, and more appropriately, this would probably be reported as net sales revenue. Okay. We would subtract our cost of goods sold of $170,000. So our gross profit would be $60,000. Then we would deduct our operating expenses. So we had utilities expense, insurance expense, wages expense, and depreciation expense. So after deducting all of those from gross profit, we would come up with operating income, sometimes referred to as EBIT, earnings before interest and taxes, of $25,500. Then we would deduct our interest expense. So our interest expense was $5,000. There was nothing mentioned in the exercise about income taxes or any type of taxes, but we would also in the real world probably need to deduct taxes after we deduct interest expense. But since we don't have any of those here, then our net income, ignoring taxes, so operating income minus interest expense, gives us net income of $20,500. And then finally, we're asked to compute earnings per share. And so our earnings per share is basically going to be our net income divided by number of shares outstanding. And so $20,500 divided by 20,000 would be $1.025 per share. That's our earnings per share. So after preparing the income statement, exercise 3.9 asks us to prepare the statement of changes in shareholders' equity. Now, you may not have seen a statement of changes in shareholders' equity in your introductory accounting classes. What you may have looked at was a more narrow statement, which was called the statement of changes in retained earnings. They are essentially trying to accomplish the same objective, which is basically to show what are some changes in the equity accounts from beginning of period to end of period. The statement of changes in shareholders' equity is just more comprehensive than the statement of changes in shareholders' equity because it's showing the changes in all of the equity accounts, not just retained earnings. So that's the only difference. So here's a typical structure for the statement of changes in shareholders' equity. And so you notice here we have all of our equity accounts listed at the top. We have common stock, paid-in capital in excess of par value, and retained earnings. And so if we add those across, we would get total shareholders' equity. If we add these columns down, we would get the balances for each component of equity. So our beginning balances, again, since this was a startup company, are zero. Okay, and then we issued stock, so we had $20,000 allocated to the common stock account, $980,000 allocated to the paid-in capital account, because again, we issued 20,000 shares at $50 per share for a total of $1 million, but 20,000 of this was allocated to the common stock account because it had a par value of $1 per share. Then we would need to show the addition of net income to retained earnings, and then finally the reduction in retained earnings associated with the payment of dividends. And so that would then give us our ending equity account balances. And so these should tie the balances for common stock, paid-in capital in excess of par, and retained earnings should tie back directly to what gets reported on the balance sheet. Okay, so let's actually look at that next. Let's look at the balance sheet next. Balance sheet, typical structure, of course, assets reported on the left, liabilities and equity reported on the right or below assets. Either way would be appropriate. And so basically what we're going to do here with the balance sheet is basically bring over from the adjusted trial balance, okay, what are the balances for each of these accounts. So we're just bringing over the numbers as we had them reported on the adjusted trial balance. So our total current assets are $763,500. We're going to report property, plant, and equipment less accumulated depreciation of $8,000. So our net property, plant, and equipment would be $1,392,000. And then our total assets as a consequence of that, current assets plus the non-current assets, $2,155,500. Then we would do the same thing for liabilities. So again, note in our liabilities section, we distinguish between current liabilities and then other, basically non-current liabilities. We make that distinction. Okay, so my total liabilities, $1,145,000. My equity accounts are going to come directly from the statement of changes in shareholders' equity. So all of these will tie back to that statement of changes in shareholders' equity. All of my asset and liability accounts are going to be reported directly from the adjusted trial balance. And so again, you see that total assets must equal total liabilities and equity. So that's kind of a quick overview of how to prepare the balance sheet. Now, the final financial statement, and the most difficult to prepare, and in many cases the most difficult for students to understand, is the cash flow statement. And so the cash flow statement, if you recall, contains three sections. The operating section, the investing section, and the financing section. Okay? And so we're going to prepare this particular cash flow statement using what's called the indirect method. And this is going to be the method that is reported in most textbooks, and it's really the method that most companies use. And so the indirect method basically starts out with net income, adds back depreciation expense, and then takes the changes in current assets and current liabilities. Okay, that's the general process that you're going to go through. The investing section and the financing section always follow the operating section in that order on the cash flow statement. So basically the cash flow statement, you're going to need some of the balance sheet information to properly prepare this. So I'm going to bring in our asset and liability and equity balances and show you how they relate to the different sections of the cash flow statement. So as we said, in the operating section, basically you have, you're reflecting your changes in current assets and current liabilities. And so this portion of your balance sheet is going to be reflected in the operating section. So changes in your current assets and current liabilities. Now, one exception to current assets is you're never going to try to put the change in cash actually in the operating section, because that's the purpose of the whole cash flow statement. The purpose of the cash flow statement is basically to take you from beginning cash to ending cash, okay? So cash is not going to be reflected. You're not going to have a change in cash in the operating section. All right, your long-term assets are going to be reflected generally in the investing section. So any change, and it's important to remember, it's changes in long-term assets are going to be reflected in the investing section. Finally, any changes in long-term liabilities or your equity accounts are going to be reflected in the financing activity section. An exception to that, even though we've got the bracket here that's including retained earnings, you're never going to have an account or a line on your cash flow statement that says change in retained earnings. And the reason for that is you're starting out with that up here. Basically, your addition to net income is a big, by starting out with the net income, that's a big component of the change in equity from one period to the next. So, that being said, let's bring in now our net income from the income statement. Let's add back our depreciation expense. And then now let's take our changes in current assets and current liabilities. And so keep in mind, this is a startup company. So the beginning balances of all the current assets and current liabilities, as well as all assets and all liabilities, the beginning balances as of the beginning of the year were all zero. Okay? So keep that in mind. So my change, I basically had an increase in accounts receivable, right? Because now I have a balance of $105,000. That increase in accounts receivable is going to be a use of cash. So I'm going to report that as an outflow here, or a bracketed negative number. The same is going to be true of prepaid insurance and inventory. Those our increases in assets, that's going to be a use or an outflow of cash. Now let's look at the increases in accounts payable and interest payable. Those, right, come directly from the current liability section of the balance sheet. Okay, and again, it's the change in those accounts, but since the beginning balances were zero, right, it's just the actual amounts reported. So we have our increase in accounts payable. That's going to be a source of cash. Okay, so if we have a liability, if a liability increases, that's going to be a source of cash for us. So liability of $140,000 for accounts payable, and then $5,000 for interest payable. So my total cash flows from operating activities would be $267,000. An outflow. Okay. Now next up we have the purchase of building and purchase of equipment. Recall that we purchased a building for $800,000. That's an $800,000 outflow of cash, and a $600,000 outflow related to equipment. Okay, next up, so our total there for investing activities, $1.4 million. Next up, we issued stock, which is a source of cash, for $1 million. We issued a note payable, again, a source of cash for $1 million. And we paid dividends, which is a use of cash, in the amount of $10,000. So that is going to give us $1,990,000 with regard to total cash flows from financing activities. Now, if we look at our cash at the beginning of the period, that was zero. Okay, so our cash at the beginning of the period was zero since this company was a startup. Our addition here, $323,000, that is the sum of cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities is $323,000. And so that then would be what our cash should be at the end of the period. And if you look, that ties back to the cash that you find reported on the balance sheet. So when you prepare your cash flow statement, it should end up it should basically reconcile with whatever your ending cash balance is that's being reported on the balance sheet. Okay, so that concludes the final exercise, part 2 of the final exercise in the accounting review booklet. I encourage you, if you have any questions, to review the videos and work through the exercise booklet.